Hello, and welcome to this month's 3 Slides in 3 Minutes. Household debt and financial health. Even though the total amount of household debt in the US keeps rising, it looks much healthier when compared to how much money and assets people have. Since the pandemic, home values and financial investments have increased a lot, which means household debt is actually low compared to overall wealth. In fact, debt as a percentage of total assets is at its lowest level in at least 25 years. Debt payments have gone up slightly because interest rates are higher than they were in 2021, but families are still spending a smaller share of their income on debt than they did before COVID. Some groups, like younger adults and renters or people who recently bought homes, are feeling more financial pressure. However, when looking at the economy as a whole, there are no major signs that households are taking on too much debt or becoming financially unstable. Higher tax refunds and consumer spending. This year, tax refunds are expected to be about 20% higher than last year, mostly because of changes in tax policy from the One Big Beautiful Bill Act. The average refund is expected to be around $3,500. Since tax filing began in late January, refunds should increase over the next few weeks. These larger refunds will likely give people a temporary boost in income during the first quarter of the year. While some of this money will be spent, most people say they plan to save it or use it to pay off debt. Because of this, loan delinquency rates, which measures missed payments, usually fall between February and April. This year, the improvement may even be stronger because refunds are larger than usual. Overall, higher refunds should slightly increase spending while also improving household financial stability. Housing market outlook and mortgage rates. High home prices and mortgage rates have made housing less affordable, which has slowed down buying and building activity. Many homeowners are also locked into older, lower mortgage rates and do not want to sell, limiting the number of homes available. However, mortgage rates are expected to fall to about 5.6% this year, which could help increase activity gradually. Experts believe home sales will improve slightly this year, rising about 3 to 4%, with bigger gains expected in 2027. New home construction is expected to grow slowly in 2026 and more strongly in 2027. As both supply and demand increase at the same time, home prices are expected to stay fairly stable rather than rising sharply. Overall, the housing market may recover slowly over the next few years, but major changes will likely take time. Thank you for taking the time, and if you have any questions, please reach out. Doug Greenberg at Pinnacle Wealth Advisory. Thank you.